Hello and welcome to NexTalks. I'm Nex, and this is where I talk. Today, as promised, we'll be talking about investing. This episode is for the people who have too much money in their savings account and they want to start putting their money to work so that they can offset those debilitating effects of inflation like we talked about in episode 1. An investment is something that you put money into expecting to get more money out of. So something like education can be considered an investment, as well as any money you put into your business or businesses in the effort to increase profits. I'm going to be talking about a few different types of investments today, but this is by no means going to be an exhaustive explanation of every type of investment available to you. Mainly, I want to focus on two major types of investing: real estate and stocks. There are a ton of different options and opinions on the best way to invest in both of these, and I am no expert. I just read a lot of books and I ask a lot of questions. I encourage you to do the same. After you finish listening to this, do your due diligence. Go out and do some research yourself. Like I said in episode 1, no one should care more about your money than you do, not even me. Plus, everyone's different. What I like to do and what works for me might not resonate with you or work for you. So please take everything I'm about to say with a big fat grain of salt, and let's dive in. Real estate is one of the most tried and true options for wealth creation and preservation. Landlords have historically been among the wealthiest classes in society. It is one of the most common assets you'll see in the wealthiest people's portfolios. Pretty much anyone that you look at who's very wealthy has some holdings in real estate. So it's good to learn about it. Now, this is a subject that I don't know a ton about. It's on my list to learn a lot more this upcoming year in 2023. So I'll share more with you when I know more. But a book that comes highly recommended by one of my close friends who has a decade-long proven track record in real estate investing is known as the BRRRR method. B-R-R-R-R. So it's a B followed by 4 R's, and it stands for buy, rehab, rent, refinance, repeat. So you buy a property that's in need of some improvements, that's a good value. You then rehab the property, which is also known as flipping the property. So you prepare it to be able to be rented. Then you find a tenant and you rent the property. And then after that, you refinance the mortgage and you use the difference to go ahead and do that again, aka repeat. So you buy another property, you flip that, you get a tenant in there, you refinance, and you use that difference because when you refinance, the amount that you paid when you got it, it was worth a lot less because it needed to be rehabbed, right? So when you refinance now, it's going to be, assuming that you did a good job, it should be worth a lot more than you originally paid for it if you're doing this properly. And then you take that amount and you use that for the next property, and you just keep doing that, wash, rinse, repeat. So I know that sounds really simple. It's not. It's hard to find good properties that don't get snatched off the market immediately by private investors. A lot of these people have relationships with each other already. So it's a lot about who you know, getting into the network, finding the right people, and finding the right deals. You're probably going to have to scour hundreds of possibilities and properties before you find a good one. So don't get discouraged. Start learning today, start researching, figure out what you're looking for, what's going to work best for you, and then take some risk. Now that's about all I have for you on real estate investing, but before we move on to stocks, I want to talk about where you're living. If you're renting, you're paying someone else's mortgage. You're in someone else's BRRRR method. They're moving towards their goals while you're incurring a pretty hefty price. Chances are rent is one of your biggest expenses if you are renting. So in my research, what I've found is that the best option for the first property for you to buy/invest in is a duplex or a multi-unit property where you can live in part of it, and then you can also get tenants in the other units who pay for the mortgage. That is your ideal situation. Yeah, it's not that easy to find these kinds of deals because this is exactly the kind of thing that gets snatched off the market really quickly. But if you put in the time and the effort and you're able to secure something like that for yourself, you're going to be way ahead of the game in your financial world. And I want to be ahead of the game too. So this is on the top of my list for what I'm looking for in this year. And the more I learn about it in my experience, the more I'll share with you. Right now, everything I'm saying is theoretical. I really have never invested in real estate myself, but I'm really excited to start learning more about that this year and to share it with you guys as well. So if there's more information that you have, more mentors or books that you want to recommend to me, please comment here, or you can reach out to me on social media as well. So now let's switch gears and talk about stocks. This is something I have done a lot more research about and have been actively investing in myself for the past several years. And like I mentioned in a previous episode, I have a pretty low appetite for risk. So the way that I invest in stocks is a bit conservative, maybe a bit boring. I follow the likes of Benjamin Graham, Warren Buffett, Charlie Munger, Phil Town, his daughter Danielle Town, etc. So the type of investing that they're best known for is value investing and buy and hold investing. So that's the type of stock investing I'm going to be talking about in this episode, but it is by no means the only option for investing in stocks. So let's start there with what is a stock? A stock is a portion of the ownership of a company. So by investing in a stock, you're actually buying a bit of a company. So you're actually an owner of that company, even if it's just a tiny little infantile percentage, you own that company. And that's how I think you should look at companies when you decide whether or not you want to invest in them. Like an all or nothing approach. Would you want to own the entire company? And if not, then why would you want to own even a small piece of it? Now, I'm sure some of you guys are sitting there thinking, well, how am I supposed to know if I want to own this company or not? What do I start with? What do I look at? How do I know? And we're going to get into that, but I just want to quickly talk about how the recession that we're dealing with right now, as I talked about in the previous episode, for people who invest like I do with the value investing, this is actually a good thing. This is when the companies are on sale. So if you've managed to stockpile enough cash in the good times, then this is when you can really load up on these value stocks, because the value of a value stock comes from its future. The idea is to buy low and sell high with investing, right? So it's important not to just buy a company because it's gone down, but to buy it because it's a company that you want to own and it's a good price. Actually, there's a quote that I believe is Warren Buffett, it might be Charlie Munger, that goes like this: "It's better to buy a great company at a fair price than it is to buy a fair company at a great price." So what's more important than the actual price, which we will get into how I run different pricing and valuation strategies to figure out what price I would be willing to pay and what is on sale for a company based on its earnings and other metrics. But what's more important than that is the company itself, its management, its mission statement, what it actually does, and how it manages its finances. So we have to look at all of those things, not just the numbers, because a lot of companies are on sale because they're not good companies. Maybe they're going out of business or they're becoming more obsolete as technology advances. And the reason that they're on sale is because they're never going to come back. So you have to make sure that it's a company that you really do believe in and that you want to own and that you think is going to increase in the future. So step one, the first criteria that the company must meet is that it must be in your personal circle of competence. If you don't know what competence means, think of it like your circle of understanding, something that you really understand in and out, or at least that you could come to understand. It's not way over your head. It's not literal rocket science. It's not something that you're going to have to get a master's degree to understand. This is something that you already know about, you're already maybe passionate about, because imagine when you own a company, you're going to have to know about it. You're going to have to learn about it and keep tabs on it and figure out what they're doing, what they're up to. It's going to have to be interesting. Are you going to want to read reports about lumber? Maybe. Are you going to want to read reports about a social media company? Maybe. Only you can answer that question. So think of this, visualize this in your mind's eye. If you're driving, don't close your eyes. Stay focused on the road. But imagine 3 circles inside of each other. So in the middle, you have the smallest circle, and that is what you know. That is your circle of competence. The next largest circle, the middle one, that is what you think you know. And it's important to know the difference. You might think you know a thing or two about social media because you have an Instagram page that you post pictures of your cat on, but do you really understand how these companies make money? Do you understand how they're run? Do you understand what a server is? I mean, how much do you really know about the ins and outs and the nitty-gritty of that industry? And then the biggest circle is what you don't know. And that's where most things in life are. That's why it's the biggest circle. You don't know most things. All of us do. We can't know everything, okay? We are not a search engine. We can't just use our brains to access all the information in the world. We don't know everything. And in fact, we actually know a pretty small amount of things. But if we can invest in that little tiny circle of competence, that's where the magic is going to happen. It's really important not to fool yourself here. Don't try to trick yourself into thinking that you understand something more thoroughly than you do. Because most things you don't know, like I said. There are things that you know that you don't know, but there's things that you don't even know you don't know. There's also things that you don't know that you know. There's, it's a whole thing. I love psychology and I could get off on a tangent about this, but kind of humble yourself and realize there's probably only a few subjects that you really are passionate about, that you really know a lot about and are willing to really research and kind of keep that finger on the pulse of a company in this industry, and try to invest there, because that's going to be where you have the most energy to stay on top of it. Because if you're investing in individual companies rather than in like a big ETF or something, which I'll talk about in a minute, then you have to really love it. You have to really be interested in it. Now, before I lose half of you being like, I don't want to be interested in these things, I don't want to research any companies, I don't want to own a company, I just want my money to make me money, let's talk about the ETF I just kind of glossed over. An ETF stands for Exchange Traded Fund, and it's similar to a mutual fund in that it has a lot of different companies in one share. So if you purchase a share or a stock of an ETF, you're actually buying a tiny portion of a lot of companies at once. So one of my personal favorites and the primary stock that I actually invest in is actually an ETF that's a total market index fund. I do the Vanguard Total Market Index Fund, which trades under ticker VTI. And the idea there is that it tries to mimic the whole market. So it buys certain companies in certain industries to try to imitate what the entire market looks like. So it's a way that you can, quote unquote, buy the whole market without having to understand the whole market. Another option is something like an S&P 500, which are the top 500 companies on the United States stock exchanges. In my research, it seems like the total market tends to outperform the S&P 500 over time, but in the short term, they tend to perform very similarly, and sometimes the S&P 500 outperforms the total market. So it's up to you. You'll have to do your research on these kinds of things. What I'm going to be talking about today is how to pick individual stocks and how to get them at a good price. But the reason that I invest in an ETF rather than a mutual fund is because it tends to have lower overhead, so you're paying less to some type of money manager, because ETFs are generally done with basically bots like AI. They buy and sell based on certain formulas rather than you having to pay a person to do the heavy lifting for you. This way you're kind of having a robot do it for you, which may or may not be more effective. It's hard to say. Everyone who invests thinks their way is best. You're just going to have to figure out what works best for you, and you're not going to hurt my feelings if you choose to reject everything I say in this episode. But for those of you who are still with me and are still interested in this, let's go ahead and put this into action. So what I challenge you to do is maybe pause this here and pick a company. Pick a company that you're interested in. Maybe it's a company you use all the time. Maybe it's just a company that you're really familiar with and it's totally in your circle of competence. And now I want you to kind of go step by step as I go through the rest of this episode and apply what I'm saying to this company. And if you have any questions or any concerns, please comment or reach out to me on social media. So how competitive is this company? Charlie Munger calls this its intrinsic and durable competitive advantage. I prefer Warren Buffett's term where he calls it a moat. Does this company have a good moat? If you think of a castle, the moat is like a big river built around the castle to keep intruders out. So with a company, their moat is a way to keep competition out. So how competitive are they? How many moats do they have? Imagine a castle that was surrounded by 5 moats. It's going to be a lot harder to get to that castle and to break it down than it would be if it only had 1, or especially if it had none. The first moat is brand. How strong is this company's brand? If you go to some random person on the street right now and ask them if they've heard of this company, will they have? Is it something that has become so closely related to the product itself that some people use the name of this company instead of the product? For instance, hey, can I have a Kleenex? Kleenex is a brand. It's not a tissue. A tissue is the object, but some people call it a Kleenex. So that is a strong brand, similar to Coke. Some people call soda Coke instead of soda. So if it has something like that going for it, that's a pretty strong moat just in and of itself, because it's had massive advertising and marketing, and it's really proven to be front of mind for so many people. And chances of it kind of disappearing in the short term, especially before you're hoping to cash out on it, are pretty slim. The next moat is known as switching or network effect. So is it difficult or painful for the users of this product or this company to switch? For example, switching from Apple to Android. If all of your products are Apple products, your phone, your tablet, your TV, if everything that you use is kind of linked together, it's going to be a lot more difficult for you to switch because you're going to have to replace a lot of devices in your home. Or maybe you get access to an exclusive network by using this product that you can't really get if you switch products or services or companies. So look at that and try to think, okay, how easy is it for someone to just kind of replace this with another company's product, like Coke or Pepsi? How difficult is it really for people to switch between those two things? In my opinion, definitely not as painful as it would be to switch between Apple and Android. The next moat is a toll bridge. So the idea here is basically, is this company virtually a monopoly in its industry? Is it nearly impossible for another company to start up and actually compete with this company? Certain railroad companies are good examples of this. With government regulations, cost, the actual infrastructure that it would take for someone to build a new railroad to compete with an existing railroad is pretty slim. So certain railroad companies have a basic, virtual monopoly in that industry. So let's say like social media, there's a lot of different competitors in this industry. It's not really that difficult for someone to start a social media company. It might be pretty hard for them to go and compete with a Facebook, but it's not impossible, and it's certainly not unheard of, as we saw with Instagram, which Facebook eventually bought. How about a secrets moat? What kind of secrets does this company have that give them a big advantage over the competition? Maybe it's a secret recipe in their food, or maybe it's something like a patent that they have, like let's say Pfizer and their patents on different medications and vaccines. Well, that gives them a really strong competitive advantage up until that patent runs out, and then people can make generic versions of them. Some companies actually choose not to patent certain inventions to keep them from having to disclose how they do something or how they make something, to keep that secret to themselves. So you might require a little bit of digging here, but what kind of secrets moat does this company have? And the final of our moats is price. How competitive is the price of this product? If we go back to our Apple example, it's pretty expensive. Pretty much all Apple products are expensive, in my opinion. They're probably overpriced. So if you are looking at a company where they are able to offer the lowest, most competitive price, that is a strong moat. That is a strong competitive advantage. If it's really difficult for the competition to lower their prices to match, then that is a strong price moat. Examples of this would be Amazon and Walmart. So if you're at a point where you feel like you have a company that you're interested in, that's in your circle of competence, that has at least a couple of competitive advantages in its industry, then the next thing you want to do is dig a little bit deeper. Who is running this company? Who's the management team? Who are the board of directors? With the modern day technology and social media, it's really easy to find out a lot of information about these people. How much are they getting paid? How much do they own of the company? How many shares do they own of the company? How invested in the company are they? How much do they seem to believe in it? Is the founder of the company still actively involved in the company? That is a big, a lot of times creators and founders of companies, once they leave, the company really struggles with innovation, and it struggles to keep that same competitive advantage it had when it had its visionary at the helm. So look at who's in charge, see what you think of them, see if that's who you would want in charge of your company. Because if you're going to buy it, it is going to be your company. There's a great book called Conscious Capitalism by John Mackey, the founder and CEO of Whole Foods, and he talks about all the different stakeholders in a company and how it's not just the shareholders, the people who buy the stock, that are stakeholders in this company. Even the employees are stakeholders. Even the customers are stakeholders. The environment itself is a stakeholder. So that was a book I really enjoyed, kind of thinking big picture and how many stakeholders there really are in this company, and how does that affect the company, and how does the company affect them? Is it having a positive impact on the environment or a negative one? All right, you're almost there. Now you have a company that you understand, you believe they have strong competitive advantages, and you believe in what they're doing. You believe in what they stand for and who's running the company. You really want to get behind this company. It's something that you believe in and that you want to invest in and that you want to own. Now you just have to find it at the right price. Now brace yourself. This is about to be a dense chunk of information that you're going to want to take some time to fully process. You'll probably have to listen to this part back a few times to really get it all, but be patient with yourself and maybe just take it one at a time. So there are 3 stock valuation and pricing strategies taught in the books Invested by Danielle Town and Rule Number 1 Investing by Phil Town, her dad. Those are 2 books I highly recommend if you are interested in learning more about investing, especially for beginners. If you're a little more advanced, you can probably skip Invested and just go straight to Rule Number 1 Investing by Phil Town. They also have a podcast by the same name. So the 3 types of strategies are known as the 10 cap pricing strategy, the payback time pricing strategy, and the margin of safety pricing strategy. So I'm going to now break down what those 3 pricing strategies are. Like I said, be patient with yourself, pause, rewind as often as you need to. Maybe you need to write some stuff down. It might be in your best interest to actually get these books so you have it physically in writing in front of you. Take your time with it. Use some spreadsheets. Don't do the math yourself. Let Excel or Google Sheets do this math for you and take it one step at a time. So all the numbers that you're going to need can be found from the company's annual report. It's known as the 10K report, and all publicly traded companies, at least in America, have to file this every single year, and they have to make it publicly available. So you can just Google it, Google the name of the company, 10K, or you can go to their website, go to Investor Relations, and you can usually find it on their website very easily as well. When you open the 10K report, don't get overwhelmed. Most of these numbers that you need are going to be towards the bottom, and you're going to become a lot more familiar and comfortable with navigating these reports the more that you do it. So take your time, be patient with yourself, just like every other part of this process, one step at a time. You are eventually going to want to become more familiar with the other information in this report, and that is exactly why we invest in that circle of competence. You're going to have to be pretty interested in this company or this industry to read all of that information, but you do want to become familiar. Like I keep saying, you want to keep your finger on the pulse of this business. You want to tune into their quarterly calls. You really want to know what's going on with them. If you are going to own the company, you have to care about it. So the 10 cap pricing strategy is just determining what is 10 times the owner earnings. So owner earnings is a concept or a number coined by Warren Buffett himself. It's the amount that can go to the owners without affecting the operating costs of the company. And you calculate this by adding the net income to the depreciation and amortization, plus the net change of accounts receivable, plus the net change of accounts payable, plus the income tax, plus the maintenance capital expenditures, and that is going to give you your owner earnings. You take that number, multiply it by 10, and that is what Warren Buffett considers a reasonable price for the company. Don't forget to divide that number by the number of shares to determine the relevant price per share. You can figure out how many shares this company has outstanding by a simple Google search. Search the name of the company and look up shares outstanding. That's the number you want to divide the owner earnings by. So the 10 cap pricing is very straightforward. The next two, you're going to have to kind of invent some numbers and take some educated guesses. So for the payback time rate, this is basically determining how long will it take you to get your money back from your investment before you start really seeing a return. So according to Danielle Town in her book Invested, which is where these pricing strategies come from, you're looking at getting your money back in about 7 to 8 years. Remember, this is buy and hold investing. This is long-term investing. This is generally a lower risk type of investment. This isn't day trading. This isn't, oh, how much money can I make off a growth stock in 1 year? This is something that's going to be something you own and hold on to for years to come. So you're going to determine an estimated growth rate. You want to choose a percentage that is reasonable and realistic based on the history of the company's free cash flow numbers. So one thing I failed to mention earlier is that you want to pick a company that has at least 10 years of data available. So if this company just became publicly traded recently, this is not a value investment. It has to have a track record. It has to have a history so that you can determine what's a reasonable amount to expect it to do in the future. So you need to choose a percentage that makes sense based on its history, and it also should reflect your own personal appetite for risk. So a lower percentage is going to reflect a lower appetite for risk, just like I said that I usually use, a conservative amount that you're guessing is going to grow each year. So you're going to multiply that percentage by what's called the free cash flow. And the way that you calculate the free cash flow is that you take the net cash provided by operating activities, you add that to the purchase of property and equipment, plus any other capital expenditures for maintenance and growth. Then you multiply that by your estimated growth rate, compounded over the next 8 years, and you determine if it's going to be a reasonable rate or not. The final pricing strategy we're going to be covering today is known as the margin of safety price, and this is based on earnings. So first, you have to figure out your minimum acceptable rate of return. This is the minimum amount of return this investment needs to give you to be worth the trouble of running all these valuations and tracking the company and all of its news. So the Towns, Danielle and Phil, they use 15%, so I do the same. They've been doing this a lot longer than I have. You may choose a different amount. Then you have to figure out the earnings generated by the company per share. This is calculated simply by dividing the reported earnings by the number of shares of the company. Then you're going to use that estimated growth rate you already have from the last strategy, just like we did with the payback time method. Only this time we're estimating the growth rate of the earnings per share, which is probably going to be different. So you look at the history, just like you did last time, look at the history of the change in that earnings per share number, and then pick something based on the history as well as your appetite for risk. And finally, you calculate an estimated P/E ratio. The P/E ratio is the price to earnings ratio, and it's the ratio for valuing a company that measures its current share price relative to its per share earnings. You don't even need to know what that means. You can just Google the P/E ratio of this company and then figure out what the average P/E ratio was for this company over the last 10 years. Get that number, and then take 2 times your estimated growth rate. So if your estimated growth rate is 15%, 2 times that would be 30%. And you're going to use the lesser of these two numbers. So either 2 times your estimated growth rate or the historic P to E ratio over the last 10 years. Take the lower of those two, and that is your estimated P to E ratio. Now you've gotten all the numbers you need, and you just have to run the math. So you multiply the earnings per share by your estimated growth rate, compound that out 10 years, and then multiply that number by your estimated P to E ratio. The result is considered a reasonable price to pay for the share. Then you're going to do something that seems a little crazy, but this is why it's called the margin of safety. You're going to divide that number by 2, because our margin of safety price is half of the reasonable price. We are looking for a company that is 50% off or more. All 3 of these pricing strategies are based on the principles of value investing. Prices like these do not come around often, and they take patience and diligence to find. This is why I invest mostly in the total market index fund, as it requires much less time and effort to monitor. Maybe I'm a nerd, but I do genuinely enjoy analyzing companies like this. So as I'm reformatting the content I'm creating, perhaps I'll have more time to dedicate to this. You can find some companies that I've done valuations on my YouTube channel, although most of those are pretty outdated, at least at the time of recording this. I can do future podcast episodes dedicated to specific companies if that sounds like something that you'd be interested in. Just let me know, comment, reach out to me on social media. Let me know if that's something you'd be interested in and what company you would be interested in hearing me do an analysis on. I might even do a video format on YouTube so that you can see the spreadsheet that I use to give you more of a visual aid for this as well. I know this has been a lot, and I want to commend you for making it this far through this episode because I know it's a super dense chunk of information. There is one last thing I would need to make sure that I highlight here, and that is asset allocation. This is the number one takeaway that I got from Tony Robbins' book, Money, Master the Game. It's a pretty big book. I definitely recommend it if you have the appetite to read a big, long book like that, but just know that my biggest takeaway from that book is asset allocation. The importance of making sure that your investment portfolio is balanced in the way that you want it. And it's going to be different depending on your age, depending on your interests, depending on your preferences. But I want to share a few of the ones that were in Tony Robbins' book that come from some pretty prolific investors, some pretty epically wealthy people, and how they balance their portfolio so you can decide what makes sense for you. And like I said earlier, take this all with a grain of salt because this book was written in 2014, so it might not be the most up-to-date information, but it's still pretty good stuff. So first we have Ray Dalio. If you don't know who he is, look him up. And he has what he calls his all seasons allocation. This is 40% long-term US bonds, 30% stocks, 15% intermediate US bonds, 7.5% gold, and 7.5% commodities. He's a billionaire, he's a hedge fund manager, he knows what he's doing with his money, probably a lot more than most of us, so it's worth listening to his advice and considering how he balances his portfolio. Then we have Jack Bogle's Keep It Simple approach, and he's the founder of Vanguard. He says 65% US total stock index. Again, take this with a grain of salt. I mean, he does manage some of these indexes. He makes money when you buy them. And 35% intermediate US bond market index. So again, instead of doing your individual research into different companies, he says just buy the whole thing, buy the whole market, buy the whole bond market, so you don't have to track all the individual companies and how they're performing. And obviously his is extremely simple in that it only has those two things. So those are kind of two pretty different examples, but shows you some different options, and hopefully you can take that information and modify it to fit your own desires and your own needs. Once you've set up your strategy, it's just a matter of sticking to it. You need to check on all the elements regularly. At least once a year, look at your portfolio, look at your asset allocation, and see if it matches up where you want it to be. chances are things are going to shift, things are going to go up, things are going to go down, and you're going to need to sell some and buy some to keep it at the asset allocation percentages that you want. And this is really one of the tricks that a lot of people use, especially the really wealthy, to keep their emotions out of the game. So rather than just being like, oh, this is great, my stocks are doing so well right now. Nope, that means, okay, bonds aren't doing good, your stocks are doing good, so you got to sell off some of those stocks and buy more bonds. And it just keeps you more disciplined and more controlled, and kind of keeps your emotions and your feelings and your intuition, your gut instincts kind of out of the game, and just keeps you more rational, logical, dollars and cents. So by picking this asset allocation ahead of time and deciding what percentages you want in what, then it's just a matter of modifying as necessary from year to year to year. You don't need to obsessively track the stock prices on a daily basis, but keep your finger on the pulse of your portfolio. Thank you so much for listening to NexTalks. I'm Nex. I talked. I hope you liked it. I'd love to hear from you. If you have thoughts on this subject, or you have something else you'd like to hear me talk about, please leave it in the comments or reach out to me on social media. If you liked this episode, please consider supporting the show at NexJuice.com. That's NexJuice.com. And I hope to catch you on another episode real soon.